are about to spend the next 4 hours with one of the world's best and most well-known futures traders, winner of numerous trading championships with real money, and perhaps the most widely read author on futures and commodities. And we're sure you'll find him to be a great teacher too. Welcome to the world of Larry Williams. Welcome to Larry Williams, Cracking the Code Investment Seminar.
Again, I'd like to thank everybody for being here and joining me in beautiful Great Falls, Montana, my home state, the Treasure State, Big Sky Country. Probably weren't exactly sure what you were getting into, learning about stocks and commodities and futures and what's the differences. I hope to explain that to you in this first hour of videotape series, so you really have a basic background of what the futures markets are about. Then after we do the basic background, I'm going to get into exactly how we trade the markets, what makes the markets go up, what makes the markets go down. But initially, unless you have the understanding of what the future markets are about, the differences between futures and stocks will probably be a little perplexing to you. So I'd like to first go over what the really big differences are between stocks and commodities or futures. What are they? Well, to begin with, the biggest difference is commodities and futures are synonymous, that a futures market is a commodity market, and we call them a futures market because unlike a stock trades forever, at least until it doesn't go bankrupt like a lot of stocks have done. And that's one of the huge differences between stocks and commodities. Wheat's not going to go bankrupt. Cattle is not going to do an Enron on us. People will always need cattle, will always need cotton, will always need gold, copper, silver. Stocks, on the other hand, are largely almost a figment of somebody's imagination. The imagination is that earnings will get better and the company will grow. But as we know, that doesn't happen with a lot of companies. They literally fall out of bed, either because they can't make it anymore, the environment has changed, the economic environment, or because we've seen a lot of this recently, a lot of bamboozlers who will kind of raid a company or mismanage a company, and the stock falls out of bed. Literally, so many stocks recently have gone from $100 a share down to zero. Incredibly, even major companies, United Airlines, Polaroid, companies that you think would last forever, are in bankruptcy. And that's the huge difference between commodities and stocks. Commodities are real. People really don't need a share of IBM when you think about it. I mean, what can you do with a share of IBM? Put it on the wall, look at it. You hope that its earnings will get better, and so the stock will go up, but nobody has to buy IBM. But people have to buy wheat. People have to sell wheat. And that's the big difference, is we're talking about a real market. And because we're talking about a real market in the futures market or commodities, we have better information. We can look at who's using the commodity, who's producing the commodity, so our insight into the commodity isn't just what people think of it, is a mutual fund buying it or speculators buying it. We can get right into, as I'm going to show you later today, right into what actually happens when the big guys are buying, and usually when they buy, we'll see the markets go up. So we have better data on a fundamental analysis. Now you'll hear the words futures and commodities. They really both mean the same thing. The reason we call them futures, and it's another big difference between stocks and commodities or futures, is commodities are delivered. Somebody actually takes delivery of wheat or corn or soybeans or gold, whereas nobody ever takes delivery of a stock of IBM. It's a certificate of paper that doesn't have any utilitarian value. But we have futures contracts that expire at something called deliveries. Typically, the delivery months will be March, June, September, and December. And that means in December, this contract of whatever it is, wheat as an example, will be delivered, and somebody will take the wheat, and they're going to take that wheat and make crackers and bread or whatever they're going to do with it. People take delivery of cocoa and make candy out of it, or sugar. These things are delivered, they're fungible, they're used. Whereas a stock certificate is never used. Because of that, it really gives us a lot of insight into the market to see what contract month that's going to expire out there people want to be a buyer of. The commercials, the large interest, which ones people want to use, and that'll help us a great deal as well when we start to analyze the structure of the marketplace itself. A couple of really big important terms you need to know about. One is called first notice day. First notice day is when a trader or a person who has a position in the market is told that this contract is going to expire pretty soon, and you're going to want to start to get out of that contract because then you'll want to be in the next contract. That's FND, first notice day. The other term you'll hear used quite a bit is last trading day. At last trading day, or LTD, that means the market doesn't trade anymore. It's over. It will be delivered at that point. Most of us don't want to have the market having a position on last trading day. We don't want to take delivery. One of the big things you hear about commodities and stocks, one of the differences, well, they're going to deliver cattle. You're going to wake up in the morning with a couple hundred head of cattle on your front lawn, or some pork bellies, or hogs, or sugar, or whatever. That's kind of a misnomer. I've taken delivery on the market. They don't really deliver it to your house. They deliver it to a place called the delivery point, and you have to go to that point and take delivery at that delivery point. There are contract specifications in a futures or commodity contract that tell us a lot about the contract itself, about the commodity. Gold must be so pure. The moisture content of wheat must maintain the contract specifications. The protein content of that wheat must hit a certain specification. And so we have a lot of specifications of exactly how good that commodity is. And one of the specifications is where it's delivered to. That's probably the biggest misnomer, is you're just not going to get delivered unless you're just totally fall asleep or want to take delivery. I actually took delivery of domestic sugar in 1973 or 74, I believe it was. And domestic sugar is primarily beet sugar. World sugar is cane sugar. Domestic sugar is a very small contract. Essentially had all the domestic sugar, bought it all. There wasn't much left after what I had, because it was such a small contract and was going limit up every single day. And it was one of my really big killings in the market. I also took a big killing the other way shortly after that in another market, but that's also the markets. Which is an interesting point. Have any of you heard that commodity trading is risky? You've heard that, right? Some of you even noticed that probably, correct? It's interesting. One of the figures that I've heard is that 80% of commodity traders lose money. In fact, the government makes investment advisors or commodity trading advisors put a great big disclaimer on that says, warning, you could lose your house, your home, your wife. Well, that's why a lot of guys trade commodities. You could lose everything. You could lose more than you put up trading commodities. All that's absolutely true. And isn't that wonderful? Because when you think about it, if somebody's losing all that money, somebody's winning all that money. My objective is to take you from those who are losing the money into the camp of who are winning the money. I can't think of any other place where there's so much money to be made. There's something like $600 million trade in the futures markets every single day or every hour or whatever the number is. Huge. Trillions of dollars trade every week in the futures markets, and a lot of money is lost. And the good news about that is for every dollar that's lost, somebody is winning that money. We just want to become the winners of that money. So we also have to recognize there's great risk there in the markets as well. But wherever there's risk, there's great rewards. If there's no great reward, there's no great risk. The neat thing about you people, commodity traders, future traders, stock speculators, is we're willing to take risk on in our lives. So few people today want to assume risk. They want the great rewards, but they don't want it with any great risk attached to it. So, when you go in McDonald's, there's going to be a sign, you're going to get fat if you eat the cheeseburger and all that stuff. Nobody wants to have individual responsibility. And that's a real different about futures traders. Part of that, if you're a speculator, and obviously you are, if you bought this videotape, or those of you who are here with me in Great Falls, Montana, you got that speculative urge inside you to do something a little bit better and try to make some money in a kind of unique way. That also tells me that you're more motivated by greed than you are by fear. People that didn't buy the videotape or don't trade commodities are outside this room. They're motivated by fear for the most part. We're motivated by greed, or we want to get ahead and make some money. We want to do something. Well, that's also our nemesis. Because greed can get you into situations where you got to be very careful of. You'll be over trading, getting into too much positions too early, and I want to make certain you don't do that. So I'm going to talk about money management in a moment, because money management is critical to the success of this business. In fact, it's in the first videotape because it's the most important thing I can teach you. When I've taken small amounts of money to millions of dollars, which I've done on a repeated number of occasions, not just once, not just twice, but 3, 4, 5, 6 times, I've actually done that. It isn't because I'm a great trader. I don't think I'm a great trader. There are other traders that are better traders than I am. But I've been able to do that because I understand money management. the ability to parlay a small amount of money into a larger amount and a larger amount and a larger amount. That's the real success of this marketplace. I think we can all be good traders, but the creation of wealth comes from the money management skill that we have and how we handle what the market gives us. That's just such a critical, important thing to us. A phrase you hear a lot, it's a phrase that Mark Twain came up with, is bullish or bearish, and so few people know what that means. Well, they know that a bullish market is one that goes up, so you'll be hearing me use that word, and a bearish market is a market that goes down. You'll be hearing me use that word as well. So bearish means we think the market is going down. Bullish, we think the market is going to go up. The term comes from Mark Twain's writing because in California in the 1850s, Mark Twain went to what were called the bull and bear fights. You may have read about those in the history books where all the cowboys and miners and 49ers would get around a great big arena and they'd have a bull fight a bear till death. And what Mark Twain noticed is that the bear clawed down with his claw. That's a down market. And a bull ripped his horns up. That was an up market. And Twain was the one who started using that in terms of economic things, and the market being in a bullish market going up, and a bearish market, the market coming down. So you'll hear that term from me and a lot of other people. Another term that's kind of complex to people we need to talk about is, and it's one of the really wonders of this business, you can make money when something goes down by doing something called selling short. Now, you can't do that in many other businesses. You might say that real estate values are going to go down wherever you live, but you can't make money because real estate values go down. In the commodity markets and in stock markets, we can actually make money when prices go down. Let me explain how that's done. This is an oversimplification, but as an example, if you think that the price of corn is going to go down, you could borrow some corn from this gentleman and sell it to the guy over here. So I just borrowed it. I've got to give it back to him. I sell it to him for, say, $3 a bushel. Corn goes down. So I now go in the market and buy corn for $2 a bushel. I give it back to him. So essentially, I have sold it at $3 to him, and I bought it at $2 to pay him back the corn that I borrowed from him. So I made $1 per bushel on the transaction. It's just the opposite of what we usually do, where we buy and hope something goes up. We buy and then we sell it. When we talk about selling short or making money when markets go down, that's just the opposite. We sell it first and then buy it back at a lower price to cover the short position. Another term you'll hear is cover a short position, and that's exactly what's happening. We're buying back to cover the short position. Granted, if the market goes up, we'll lose money on it. If we sell it to him for $3 a bushel and now it goes to $3.50 or $4 a bushel, we have to buy and cover to cover our loss, and we're going to have a loss on the transaction. But if you do think a market's going to go down, there's a tremendous amount of money to be made selling short in down markets, like the NASDAQ or these high-tech flyers, these stocks you could sell short, commodities you can sell short. There's been some huge fortunes made on the short side of the market. So this is not a one-way street of buying and hoping it goes higher. We can make money when it goes up. We can make money when it goes down. Interesting, in some countries, I was in China recently, you cannot sell short in China. You can only buy long. So the markets trade a little bit differently than our markets do, because it's all on the buy side. There's no short selling in the marketplace. I guess the biggest difference between stocks and commodities is really it's a much more advantageous game to us financially. By that, let me explain it to you. If you're going to buy a share of stock right now, or 1,000 shares of stock, you've got to put up all of that cash. If you want to buy $60,000 worth of General Electric, you've got to put up $60,000. If you don't want to do that, the broker will lend you some of the money, and maybe you have to put up 60% of that, and the broker lends you the other 40%. And he's going to charge you interest on it. So you've got to put up a lot of money to do it. By the same token, if I want to buy $100,000 of Treasury bonds, that's a futures contract, that's $100,000 per contract. That's what it would take to buy the contract. But in the commodity market, you're not buying the physical possession of the commodity, you're putting up a margin deposit. And that's going to be about 10% of whatever the commodity is, sometimes a lot less. In the case of Treasury bonds, to buy $100,000 worth of Treasury bonds, currently the margin is $3,000. So there's another $97,000 there, isn't there? But there's no interest charged on that, because you're buying a futures contract, you're putting up the margin for it. You're saying when it comes to delivery, I'll either get out of it or I'll put up the $97,000. But you don't have to put up all of the money for it. You only have to put up about 10% of the money for it, and you don't get charged interest on the balance. Wow, that's wonderful, isn't it? What a world of difference that is between stocks, where you always have interest charge if you're on margin, and you've got to put up a huge amount of money, versus in the future markets, we usually put up about 10% of the money. Now that math gets really interesting, because if you put up 10% of the money, and wheat or corn or treasury bonds have a 10% move, you've made 100% on your money. That's great. But that knife cuts two ways. If you put up 10% and it goes down 10%, well, you've lost exactly what you put up. But you can get more bang for your buck as the bottom line in this than the stock market by a long ways. Now, there's some other ways you can get more bang for your buck in the option markets, single stock futures, but I found most of those are pretty speculative and a little difficult to understand. Better to start with just the basics. Generally speaking, for commodities, you'll put up 10%. That's called margin. Your broker will ask you to put up a margin deposit. Now, these margins fluctuate and change from time to time as well. Do you remember the silver crisis we had when silver went up to, I don't know what, $30 an ounce, something like that, and gold went to the moon during the Carter administration? Well, then the Hunt family, remember the Hunt family had cornered the silver market. And then one day the exchange themselves changed the margin requirements. So the exchange, not your broker, but the exchange will set the margin requirements. And then your broker may want it higher than the margin that the exchange wants, because they think it's a more speculative market. But margins are set by the exchange. In the case of the Hunt instance, the Hunt brothers were way ahead of the game, and a lot of members of the exchange were losing in that move. And the exchanges changed the margins, and that was the top of the silver market, and that's what broke the silver squeeze that the Hunts had, and basically why they ended up losing. They didn't realize that the margin, the rules, if you will, could be changed, and the rules got changed, and silver went down, I think, something like 25, 30 days in a row limit, and that decimated the Hunt family. So it's so helpful to know that, margins can change. Your broker doesn't set up margins. The other thing we need to talk about is commissions, because wherever you're going to trade, you have to trade through a brokerage firm, and the brokers are going to charge you commission. And there's a really high value a lot of brokerage firms will try to get you to pay, and there's probably a legitimate value. And let me try to talk a little bit about it, because commissions are our cost of doing business. And as in any business, you want to keep your costs low. If your cost is high, it's going to be more difficult to succeed. It's not unusual to see brokerage firms charging $100 commission. And they'll say, well, that's $50 to buy and $50 to get you out. Well, that's exorbitant. However, it may not be exorbitant in this instance. If a person calls a broker every single day, calls them on their 800 number, has them fax this, email that, gets their newsletters, all that, and puts on one trade a year, well, $100 probably isn't a bad cost for him to pay, because he's costing the brokerage firm a lot of money. But if you're trading in any size or any frequency at all, that's an exorbitant amount of money to pay. Generally speaking, most of us should be paying somewhere between $25 and maybe $45 if we're trading with any frequency at all. If you're trading with less frequency, yeah, your broker will probably charge you more. It just depends on how frequently you're trading in the marketplace. But if you're doing any consistent trading in the market, your fee is going to be $25 to $45, $50, somewhere in that area. So just keep it in that zone, and remember these rates are negotiable. You can always tell your broker, I'm going to another brokerage firm, and bring that cost of doing business down. It depends on what your broker does for you. My main broker does a lot of stuff for me. I'm actually trading today. He's got all my orders, so he's watching everything for me. So I don't mind that he charged me a little bit more than what I could probably get. But it's like in anything, you get what you pay for. But don't pay too much. Somebody wants to charge $100 or $50, $60 for a commission, then you're either trading very little, or they're doing a whole lot of work for you to justify that type of a fee in the marketplace. Well, let's talk a little bit about money management, and then I'm going to show you how the market structure itself works. Money management, I said, is the most important thing that I can teach you. It usually just makes people get really sleepy. Oh, money management, everybody wants to know when to buy, when to sell, because that's the excitement of this business. Everybody's seen the movie Trading Places or Wall Street, and everybody wants to get and start trading right away. But this is a very emotional business. If any of you that have been here, that you've traded, how many of you traded? Just raise your hand, those people who've traded. Have you ever noticed this is emotional? Do any of you get kind of emotional about this on occasion? Sure do, don't you? And here's why. Money is at risk. And your ego is at risk. And the human mind seems to be programmed to want to be right. And I can never be right as a commodity trader. I have never been right in my trading career. Made a lot of money at it, but I've never been right. By that I mean on my winning trades, I've never had enough contracts. My losing trades, I've had too many contracts. My winning trades, I probably could have held for more profit. Boy, that happens to me all the time. I leave a lot of money on the table. And every losing trade, I should have got out sooner. So you're never right, and it's a really difficult thing because we want to be correct in what we do. We want to be right. We want to feel like we're really good at what we do, but you can never be correct in this business. Never be right, ultimately, like a doctor's right. He sewed the guy up and he got better. We're always going to have error, and that causes us to just like, God, I want to be right, and you can't be right in this business. The other thing, and this is the really critical point, why we get so emotional and people really get emotional in this business. I've had 6 friends commit suicide. 2 of them here in Montana. One in West Yellowstone, one in Kalispell. One was not a Montanan, but another was a professional baseball player, a great baseball player. But the emotions of the marketplace got to these people. Why? Because of this. The analogy I used before, if we were to flip a quarter for heads or tails, if I match you, I get your quarter. If I don't match you, you get my quarter. You don't have a problem doing that bet, probably, right? But if we do it for $36,000, now how do you feel about it? Different ball game, isn't it? So it's the same physical thing, flipping a coin, looking at it's a head or a tail, and it's the amount of money that makes you emotional. It's not the action of calling up your broker and saying, buy a contract of S&Ps or buy soybean oil or buy hogs. That's not it. It's how much money is behind the bet. So in a way, I'll use some gambling talk, and it's different than gambling. What we do is we speculate. We're not gamblers. People so often say, oh, Larry, you're just a gambler. No, I don't gamble. Because ultimately in gambling, the odds are against you. The house is going to win. I'm a speculator. Specular is the proverb or the word where the word comes from. To see, speculate is to see. Spectacles, speculation comes about seeing things and noticing things and taking advantage of those things. That's the difference. A gambler is trying to beat odds you can't beat and come in at the right time. That's all he can do. But as speculators, we can observe conditions. Say, oh, there's a drought, there's no wheat around this year, or I can observe that the commercials are heavy buyers of a commodity or heavy sellers. I can kind of learn about the market, and that's what a speculator does. He observes these things and then takes action based on those things. One of the things that I've heard gamblers talk about, you'll hear this a lot if you go to Las Vegas, the pit bosses will tell people to win big, you gotta bet big. That's the biggest fallacy there is. Well, unless you're the house. They want you to bet big, because the bigger you bet, they're going to get it from you at some point. What I like to do is start betting small. And then as I start to make money and have more money, then I'll start to increase the size of my position, my bet, if you will, in that parlance. So it's house money. It's money that I've made, so I don't have huge amounts of money at risk, which is really an exciting thing to me about the commodity markets. You don't have to come into this business with hundreds of thousands of dollars to trade. You can have $5,000, $10,000 and start trading. That's not unusual to see people come in with a small amount of money and run up to a large amount of money. But I've seen a lot of people start with $100,000, $200,000 and run it down because they think, well, I'm so smart, I made all my money in whatever, so I'm smart enough to trade commodities, and they just start trading, listening to a broker, and all of a sudden, boom, 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 down goes the equity in their account. because they haven't taken the time to learn the markets. And they're betting too big. So let's talk a little bit about the size of what your bets should be, your wagers, if you will. I think as a general operating rule, for every $10,000 that you have that you're going to open a commodity account with, you should trade one commodity, one contract. That's plenty. Now the object is as you start to make money, let's say you have an account that has, we'll use a $20,000 account. I have $20,000 in my account, so I could trade two contracts. Hopefully, at some point, I'm going to start making money, and that account is going to go up. Will have made $10,000, and I now have $30,000, so now I can trade three contracts. And maybe I lose money again, and it goes back to $20,000. I'm back to trading two contracts. We get this up now to $40,000, so now I'm trading four contracts. And if you look at my trading results, which you can see on the internet on the commoditytiming.com, you'll actually see when I won the Robbins World Cup Trading Championship, how I started trading very few number of contracts, and then I got to hundreds of contracts. 400, 500, 600 bonds, 1,000 bonds. But I started with only $10,000 and ran that up to $1.1 million, $1.2 million. And it was because I was using this type of a money management approach. When my daughter also won the same championship, she started with $10,000, and if you look at her account, you'll see she's first trading one contract, then she goes 2, 3, she gets up to 4, and then she's lost money, and so it goes down to 3, goes down to 2, and then it goes 4, 5, 6, 7, 8. It stays at 8 for a while. I think it dips down to 7, then it goes 9 and 10 contracts. As she made more money, she traded more contracts. That was why a 16-year-old kid was able to win the trading championship. Not she's a great trader, but she had a good sense of money management. She had a real tight money management approach to take. Basically says the more money you have in your account, the more contracts you can trade. And the best general operating rule is for every $10,000, let's trade one contract, one commodity. There is one exception to that. There's a futures contract called the S&P 500. That's what I trade. That's my bread and butter contract. Margin's real high on that, though. The margin fluctuates. Recently, it's been $30,000 down to about $20,000. So you've got to have more money for that contract. For that, you've got to have about probably $40,000 to trade one contract. I actually trade even lighter than that. I think my ratio is about one contract for every $80,000. But that way, if I get tagged, if I get hurt, I still have plenty of money to trade with. Because I will assure you of this, you will have a losing trade as a commodity trader. It's going to happen. You're not going to have a straight path to heaven. So you have to protect yourself from a loss. And if you have all your money bet on one trade, you're going to lose all your money on one trade. It's just like Russian roulette. You know how Russian roulette's played? There's one bullet in the chamber, they spin it, and click, spin it, click, spin it, click, spin it, click. Well, if you do that often enough, what's going to happen? Bang, right? Absolutely, bang. It will happen. And that's the same thing as overtrading or having too much, all of your money on one trade. You can go boom, boom, boom. I have a lot of winning trades in a row, but you have all your money on one trade. Eventually, you will have a losing trade, and away goes the money. So I want to have a small portion of my money in the market, not a large portion of my money in the market on a percentage basis. On that $10,000 account, if you have $10,000 in your account, the margin on most commodities is going to be about $1,000 all the way up to $3,000 for bonds. Coffee might be a little bit higher. It might be $1,500. But we're not using the bulk of our money. We're sitting on a bank, if you will, for most of our money. We don't want to risk all of our money on one trade. That's why that figure I talked about earlier, 80 or 90% of people lose money trading commodities. That's why. The only two reasons why you lose a lot of money trading commodities. You have very bad advice, or you're not using money management. You're betting all the farm on every single trade, and that's what you just don't want to do. So small bets, small amount of your capital is what we're going to risk on any given trade. So if we're wrong, we can come right back in the game and we're ready to trade again. Money management is the only defense that we have as speculators. We're going to make a decision. We're going to try to be intelligent, do the right thing. But our defense against disaster is money management. Don't risk too much. You risk very much money, you're going to lose very much money. So we risk a little amount of money, so we can only lose a bit of our money. You just got to always think of that. Small bets are the important thing. You don't want to bet the farm on any given trade. In fact, I'll tell you this, and some of you, let me know if this is right or wrong. The next time you decide you want to put everything on one trade, would you call me? Collect? Because I'll take the opposite side of that trade. I've noticed this in my own trading. Whenever I think I got this all figured out, I'm going to bet big on this trade, invariably that's a losing trade. Well, I've learned just be real consistent with my unit size as a percentage of my money. Whenever I get that King Kong feeling and thinking I'm in control of the world, and I buy too many contracts, and I've been known to do that, down it goes. That's just wrong. I don't know why it works that way, but have any of you noticed that with your, when you think, I got it all figured out, well, you got a new lesson to learn. When I was a young kid in trading, especially here in Montana, it was kind of interesting for me too. I mean, growing up in Montana, and it's all familiar to everybody here, and may not be to people watching this videotape throughout the world, is on our radio stations every single day around noontime and in the morning we get a commodity report. We get the grain report, what the meat market's doing, what the grains are doing. So we grew up with that. And I grew up knowing about agricultural commodities, and we didn't listen much about the stock market report. So it's kind of ingrained in us to think about agriculture, because states like Montana, Wyoming, Idaho, we're the producers of all the agricultural commodities that people in the cities use, but they don't pay much attention to prices until they find out that there's trading opportunities in them. And that's when they start to look at them. The farmer has a more difficult problem, a real hard problem. He's the producer of the commodity. On a commercial basis, we have the producers and we have the users of commodities. Producer is going to be the guy who grows the wheat, raises the cattle. The users will be Pillsbury or Omaha Beef, whoever is going to take delivery and use this commodity. The producer is at a disadvantage because of this. The only business I know of where you create a product, wheat, barley, oats, whatever it is, and then you go to the marketplace and say, what are you going to give me for it? Every other business produces a product and says, hey, I want $19.95 for whatever this is. I want $436 for my television set. But you don't have that luxury in the agricultural business. There you go to the marketplace, and the market says, well, we're selling for $3.35 today. You go, well, that's not enough money. Tough. Well, so you have a choice. You can put it in bins, unless your product is milk, which doesn't last nearly as long as wheat does. So you always have that problem. The market dictates the price. And because of that, a producer probably needs to look at hedging. I'll talk about that more in one of the tapes, about the different structure of the price and looking at when you want to sell. For producers of commodities, I know a lot of you are, you're probably going to want to pay a lot of attention to the seasonal tendency of the market. These markets have strong seasonal tendencies when they usually top out and when they usually bottom. That's a real helpful insight for a producer of a commodity. Now, if we can look inside that mind of these producers and users, we can see what the market should do, but how can we get inside their mind? Let me show you something. It's available in just about every newspaper in the world on a daily basis. You can actually learn right in the newspaper what's going to most likely happen in the commodity market. Now, this is out of the Great Falls Tribune. I'm certain everybody's heard about the Great Falls Tribune, at least in this room. Outside of Montana, probably not, but it's right there. It's in most every single newspaper every day. We have a listing of grains and livestock prices, Kansas City, Portland, Minneapolis, and these numbers will actually show us a great deal about what's going on in the marketplace. So much information in your daily newspaper. Right there, it's telling us something. I learned this from one of my mentors, an old guy, Bill Meehan, who came to my office one day, and somebody said, Larry, your timing in the market's pretty good, but you don't have any sense of what market to be in. This guy has got really good sense of selection of markets. You ought to get together. So Bill came to my office. He said, well, let's talk a little bit. And we talked. And he said, I've been traveling. I don't know what the markets are doing. I said, well, what do you think is going to happen? He said, well, I don't know, but give me a copy of the newspaper. So I got him a newspaper, and he just sat in a chair and looked at that, and he started looking at that sheet like I just showed you. Yep. Wheat's going to rally in July. This is like March. How do you know that? He says, yeah, soybeans, yeah, they're not going to rally. So, soybean oil, though, that's going to rally in September. But holy Toledo, how can you find that out from looking at a newspaper? It just blew me away. And he said, well, this is how, Larry, and I'd like to show you what Bill showed me. These markets, remember we talked about have delivery months. Typical delivery month would be September. Well, let's start with March, then June. We have September, and this will vary from market to market, and December. And then you have next March, and next June, next September, and next December. And the price in the newspaper will show the closing price for the day. And it'll usually show the net change for the day. Is it up or is it down for the day? And what Bill was noticing in there was that March soybean oil, or whatever it was selling for maybe $3.10. The June was selling for $3.20. The Sep for $3.40. And the December for maybe $3.80. And the next March for maybe $4. What he pointed out to me is that commodities have something called a carrying charge. The guy who has the March contract of this, who has to deliver that or owns it even, has a long time between this March and this March, 12 months of risk, insurance cost, exposure, interest on storing, holding on to whatever the commodity is. So as we go out in time, the commodity price becomes more expensive as we go out in time. That's a typical carrying charge market, called a carrying charge, because you have to carry the cost of this market in time. Time costs money. We all know that. That's the way markets are most all the time. That's not an unusual or abnormal situation. That's just the way that it is. The opposite of that on occasion happens, and now that's totally different. And this is what Bill was looking at, which has told me so much over the years since I learned this from Bill in 1970. If this March contract is, say, $3.60, and the next month is $3.10, and then it's $3, and maybe it's $2.90, and down here it's $2.80, notice what's happened. It's cheaper as we go out in time. Why? It's more expensive here in the nearby month. There's only one reason that can happen, and it's this. Somebody wants this nearby contract badly. They want it so bad that they have bid it to a premium. Remember, this is the normal operation of prices. That's the way it is almost all of the time. There's a carrying charge. But when this gets inverted or upset, there's a premium in the marketplace. And the premium means somebody wants us so much they're willing to pay more today than for a distant contract. Oh boy, that doesn't happen very often, but it's wildly bullish. Because who could that be? It's not us. We're just little guys. We can't move this market. There's only one player in the game that can do that, and that's the commercials. The people that are taking delivery of the product, not the producer. Remember, the producer comes to the marketplace and says, well, here's my wheat. What do I get for it? Yeah, the user, the person that wants to buy it and take delivery of it, wants it so badly that they'll bid it to a premium. And that's an inversion or a premium price structure. You don't see this very often. But when you do, it's terribly important. I should point out this only applies to the agricultural commodities. It does not apply to the financial markets. But the agricultural markets, which is where most of you should start trading incidentally, lower margins, lower volatility, not as wild, a lot better information. So I'd start to cut my teeth on these ag markets instead. When you see this situation, it's just like, oh, that's a commercial-driven bull market. Now this premium will come on. Let me show you what that will look like. If we were to look at a market coming down, something like this, maybe going up, we can look at the difference between the nearby and the distant month. At this point, we're in a negative carrying charge market. But where we start to go positive, i.e. the nearby contract is selling for more than the next month out, that tends to come after a market low, a little bit after the market low. Sometimes it may occur over here before the market low, but usually it's a little bit after the market low. Then as this market runs up, the premium will go up and eventually it will come off and it will fade as the market starts to top out in here. My point is this: just because there's a premium in the market doesn't mean that the market's going to go higher. It's when the premium comes on that the bull market begins. If you're losing premium, i.e. that amount of difference between the nearby month and the next month that's getting smaller and smaller, then you're probably at the end of this market. So you can't just look at just the numbers and say, oh, there's a premium. That's a bullish suggestion, certainly. But you'd want to take one more look at it to see, well, is the premium building up or is the premium falling off? If the premium's falling off, it's not nearly as constructive. You want to see where that premium continues to build up and up. I'll show some actual examples on the computer in one of the other tapes where you'll see markets that will do something like this. A market runs up and starts to come down. The premium, though, Coco had a great example of that this year. The premium, though, had started to come up, and in the decline of price, this is price, this premium actually continued to build. In other words, the commercials wanted this so badly during the decline, they bought the heck out of the decline. That's unusual. People usually don't like to buy declines. But if you see a declining market and the premium is building up, i.e. the nearby contract day after day either doesn't decline as much as the next month out or actually rallies a little bit, the premium increases, very, very bullish situation for an intermediate term move in the marketplace. The opposite side of that would be equally true. If a market has a nice up move and that premium starts to dissipate, so price is going higher, but we're losing premium, that means we're close to a market high. And that's one of the things I love about this business of trading commodities. We get to look at fundamental stuff. There are two types of traders in the marketplace: technicians or technical traders and fundamental traders. I'd much prefer you spend a lot of time as fundamental traders and then bring the technical stuff in later on. Technical stuff, you probably all heard about it. Those people that look at charts and wiggles and waggles on charts and try to read tea leaves at midnight. That's what technicians do. The other side of that are fundamental. People look at supply figures, demand figures, maybe what the commercials are doing, stuff like that. That's the real cause of the marketplace. I can't think of a better place to start than with the fundamental conditions of the marketplace, which is what this tape and the next tape are about. Then later on we bring in the mumbo-jumbo of technical analysis and chart reading. And I really think that that's what technical analysis is. It's largely a lot of mumbo-jumbo. And I'll show you why. The analogy that I like is this. If we have a boat out on an ocean, and there's a smokestack of the boat, and we have waves coming along in the ocean. And if we look at the waves coming off the boat, that's what technicians are doing. They're looking at this boat out in the ocean, and they're looking maybe the smoke coming out of the smokestack, and they're saying, yep, that boat's been going in this direction. And they're absolutely right. Those waves and that smoke will show you exactly where the boat's been going. But the problem is, that's not the future. The future begins right here. Looking at charts will tell you where the market's been, but not necessarily where it's going to go, because you've got a guy up here who's steering this boat on a steering wheel. And this is the commercial. These guys can take this market in a heartbeat and spin it wherever direction they want to spin it. So I'm much more concerned about who's in control of the market as opposed to the technical aspect where the market's been. The technical stuff, for the most part, shows us trend. It can be used, but on top of a fundamental condition. It's really as simple as this. What buy signal would work better? A buy signal in a fundamentally bullish market or a technical buy signal in a bearish market? Well, obviously, in a bullish market. So we want to know what the fundamentals are. That's the most important. That's the base that we need to have. And that's so cool about what we do, because in the stock market it's real tough to get into fundamental analysis of a stock for a couple of reasons. They lie, right? I say, well, our earnings were this, and then they readjust the earnings. Or they say the earnings were this and this and this and this, and then we found out they didn't even have any earnings. But when people are buying and driving a market to a premium, that's really happening. Somebody's plunking money down and they're moving a market with real money, large amounts of money. We know what they're doing. That's fundamentally correct about the marketplace. There's also a report that comes out every week that shows what these large traders and small traders and the commercials are doing. We can actually go look on a government website and it'll tell us if they're buyers or if they're sellers. So, and that's not what their conjecture is, or they're not trying to hide something from us. That's their actual trading, what they did with real money. So we can look at that as well to say, this is the smartest guys with the most money in the business. This is what they're doing. If that's what they're doing, it's probably what we should be doing as investors or traders in the marketplace. We have fundamental traders. We have technical traders. I'm kind of both. I like to use the fundamentals to set up the market. That's what we'll be talking about in this first 3 tapes. And then the technical aspect to kick me in and say, now buy today. The market's set up, it's going to have a rally. See, I don't think charts move markets. I think markets move the charts. So I want to get the market set up and then bring in the technical analysis. There's also a couple of other types of traders you should know about. It's a time trader. Everybody by now has heard of day traders, right? That was a really big phenomenon in America for quite a while during the hot stock market. Everybody became day traders and everybody lost a lot of money. They made money initially because as a day trader, if they were wrong, they said, well, I'll hold it another day. And eventually the bull market bailed them out and they got out and they thought they were really great traders. But when the market stopped going up, they still held on those losing trades and they didn't go back, and then they lost all their money. Day trading is the most difficult form of trading there is. If somebody recommends you start as a day trader, boy, I just grab my wallet and run, don't walk out of there. Really hard to day trade. I do it, but it's real difficult. Then there's short-term trading. In my case, that's my average trade is probably about 3 days I'm going to trade. Then we have what most of you should be trading is a time frame of anywhere from 3 to maybe 15, 20 days. That's being an intermediate-term trader. Then a longer-term trader is anything after maybe 20, 30 days. Really hard to hold on to a position that long unless it just blasts off and runs up in a big move. Well, then maybe you can hold on to it. But most of these markets are gyrational like that, and they'll have a move of 15 to 30 days, and that's the size of the move you want to catch. There's enough money in that move, you can do real well. But to try to predict a 3 or 4 year bull market, that's real tough. Plus you have these big pullbacks against you, and those markets are hard to sit through. Invariably, you get out right at the low just before it goes up again. So most of us, my experience after lecturing thousands of people in virtually every free country in the world, is that most people, and it's interesting, it doesn't matter if I'm Russia or China or Singapore or Australia or New Zealand, France, Italy, Germany, England, most people like to hold on to a trade for about 15, 20 days. And some people will say, well, you could do this, and we can do these imaginary scenarios, but the real time, what you're actually going to experience in your life as a trader is probably anywhere from 15 to 30 days. Can be an eternity in this business. Occasionally you get a move that'll last longer than that, and I'll have some techniques to hold you into those long-term trend moves when they occur. But for most of us, intermediate trend move is probably going to be anywhere from a week to about 3-4 weeks, and that's about as much pressure as we can stand from this marketplace. But the big thing, remember, is what's your time frame? Now, some of you might have a longer term time frame than that. You might want to be a long-term trader that's going to hold on for 6, 7, 8 months. That could well be the case, but you just need to say, this is my time frame. And let me give you some suggestions on time frame. Your time frame, it really depends on your personality. When I was a young sprout, I was trading a lot, very, very short-term, intraday, day trading stuff. But now at 61 years of age, I'm going, well, you know what, I don't want to day trade. I need one more trade like I need another hole in my head. I want to take trades that last a little bit longer so I can go fishing during the day and see what happened, come back and see what took place during the market session. If you're going to be a short-term trader, probably in high school you were a sprinter, you were a runner, you're a real quick response mechanism. I kind of like to ponder things and think about them a little bit, and kind of roll an idea over my mind a little bit. So as a basic trading style, I've probably always been a 2 to 5, 6 day trader. I don't like holding on to things forever, but some people do. So you need to say, what's my personality? And then you trade your personality. You can't be me, I can't be you. You have to find your basic temperament, and that's the time frame that you can trade with. So your temperament equals your time frame. And I just give you some general ideas, and after you start to trade a little bit, you try, oh yeah, I like to hold for this long. So you want to develop your indicators and your trading style for that time period that's comfortable for you. That's going to be important for you. The other thing that's important is paper trading. A lot of people say, gee, Larry, I want to start trading today. I really like this. I want to start buying and selling tomorrow. I want to make a fortune overnight. And my advice to you would be, don't do that. You want to start what we call paper trading. That means you're going to look at the newspaper, look at your charts or whatever, and one day you're going to say, you know what? I think it's time to buy cattle. So you write, buy cattle. And maybe you're going to buy it at 64.50. So you just write that. You don't call your broker. You just write that down in a notebook. And then when it's time to sell cattle or take your loss, you're going to say, okay, I sold cattle. Maybe I sold it for 66.50. And then you say, how much did I make? And you do that for a while. You're trading on paper. It doesn't cost you a cent. And that's a great thing about this business. Probably the greatest thing. You can learn it without risking a penny. I don't know any other business, whether it's a shoe shine parlor or a hot dog stand, you got to have capital. You're probably going to lose capital for who knows how long before you figure out how to shine shoes or sell hot dogs or whatever it is. But we can learn on paper pretty much how to be a successful trader. Now, there's no guarantee that just because you can do it on paper, you can do it with real money, but it's a lot better assurance that you're going to be able to. You will have gone through the experience here of learning to trade on paper without risking money. You'll see, gee, did I put in the order correctly? Was I in the right market? Well, you learn all the little intricacies of the marketplace trading. Let me give you some examples of how good this paper trading can be. One of my better traders was a professional race car driver. Used to see him on ESPN on almost any given Sunday racing cars. I was talking to him one time, and I said, well, how's your trading going? He said, well, I'm just ready to start now. I said, really? He says, yeah, I've been paper trading 18 months. I said, wow, that's a long time. He said, well, you know, Larry, I didn't start with Formula Ones. I started with soapbox derbies as a kid. And I figured this is as risky as what I do, and I wanted to start small because that's how I became a successful race car driver. But gee, that's interesting, isn't it? So he just built that up slowly until he felt he had control and understanding of what he was doing. Then he started trading, and you don't see him racing cars anymore. He's a trader. There's a great analogy. I don't know if we have any. Do we have any medical doctors in this room? Any MDs? I always ask doctors, in your first week at medical school, did you get to cut into somebody? You know, watch the blood come out and do that? Oh, no. They don't get to cut into somebody until maybe the third year of medical school. They have cadavers. And that's what I call paper trading. Basically, they're cutting up dead bodies and going in and learning on a dead body where they can't do too much damage. I don't know, can't do any damage, I guess, on a dead body. But that's their form of paper trading. Lawyers have moot trials, right? Mock trial sessions where they learn their skills. We need to do more paper trading as a beginner. And there are a lot of websites that will let you paper trade and won't charge anything for it. You say, I'm going to buy this today and do that today, and it'll record how you're doing. Some of the software will allow you to do that that's out there, so you can actually keep a record of your own buying and selling until you get up enough confidence to say, yeah, I think I understand how this game is played. Again, there's no 100% assurance you'll be successful in the future, but it's a lot better to learn to paper trade than it is to just jump into this thing and start trading. So I'd really strongly suggest those who haven't traded to start as paper traders. Do it for probably at least 30 days, hopefully 3 months. I got to tell you this story too. One of these guys at my seminar one time came up and I asked him, said, you know, how's your trading going? What's your? He says, well, I'm about ready to start trading. I said, wait. I said, you've been to come to my seminars for a long time. He says, yep, 6 years. Now, that's probably a little too long to paper trade, okay? 6 years he paper traded. I couldn't do that because I want to find out, you know, am I good or not? Can I make money at this or not? So 6 years is probably too long. 18 months is maybe stretching a little bit, but at least a couple, 3 months under your belt before you just jump into this and start doing it, because people do lose money at it. It's a risky business. So let's learn our skills on a cadaver, if you will, on a soapbox derby before we just jump in and start trading the markets, because this trading is so much fun. You guys like to trade? Guys and gals that are here? Isn't it fun to do? That's the trouble with it. It's so much fun we overtrade. One of the best adages I've ever learned in my life was from an airline pilot. He said, as pilots, Larry, he said, well, there's an old adage, and I thought he was going to say the one about there are a lot of bold pilots and there are a lot of old pilots, but there are no old, bold pilots. I thought that was the card he was going to bring out. But instead, he taught me something different. He said, no. He says, it's a lot better to be on the ground wishing you were in the air than to be in the air praying that you were on the ground. So that's just like trading commodities. It's a lot better to be looking at your chart and saying, darn, I wish I was in a position, than to be over trading and in a position say, how do I get in touch with Larry? What do I do now? It's so much better to learn on the ground, on ground school, if you will, and to trade less often. That's the big problem most of us have. We overtrade. Now, when I was a young guy starting out in this business, I've never been a broker. I've had a lot of friends that are brokers. And the brokerage adage back then, I don't know what it is now, but back then it was for every $10,000 that a customer had in his account, he should generate $30,000 of commission in a year. 3 times your equity is what the brokerage firm thought they would get in commission. Now that's changed a little bit now. I think it's like a 1-to-1 ratio. Commissions are a little bit less now than they were back then. Some people figured out you don't want to overtrade a little, but that's a lot of money. The cost of, and people they seem to almost enjoy losing money. I've never understood that. I've never found it particularly fun to lose money. But some people don't seem to mind to just watch their entire life savings dwindle away trading. And it's different for everybody. One of my brokers in Chicago one time called up this customer of his and said, Ben, you've lost money with me every year. About $30,000 to $33,000 now, 6-7 years in a row. He called him up the last part of December. He said, you don't have to trade with me. Why just don't trade this coming year? Paper trade, do whatever, just don't trade. The guy said, well, Ed, says, I got to tell you something. I live in this little tiny small town here. I don't chase women, I don't drink, there's no fun, but the one thing I really like to do is trading these commodities, and I know it's going to be about $30,000 I'm going to lose every year, and I just stop right at that point. He said, but this is my thrill in life. He says, one of these years, I'm going to do real well. So you have to kind of say, what's your risk tolerance for this? In his case, he just kind of programmed every year. He's going to lose $30,000, but he got that much joy out of it, I guess. I never got much joy out of losing money. But you kind of have to say, what are your parameters? And so when you come into this, part of your money management is to say, look, I'm going to come in with X amount of money, and if I lose X amount of money, I'm out of here. I didn't do something right. Larry didn't teach me right. Whatever it was, it didn't work for me. Not everybody can be a great commodity trader. Not everybody can be a great musician. My dad was one heck of a carpenter and a great mechanic. I tried to build a doghouse for my son and couldn't do it. I didn't have a clue. I was just the worst. I was a disaster. I thought I'd have some of the same abilities my dad did. He taught me some of this stuff, but some people can cook, some can't cook. Some can trade commodities, some can't trade commodities. The sooner you find out you can't cook, the better it is that you start eating out or marry somebody that can cook. And it's the same thing with commodities. If you realize, I just don't get this, then stop. You're through with it. You learned your lesson. You still have learned a lot about how markets work, what they do. You'll be conversant about it to a great deal. Some people just can't trade, literally cannot trade. The year that my daughter won the Robbins World Cup Trading Championship, took $10,000 to $110,000. She did it basically following one of my hotlines, and another guy following the exact same hotline lost money. They both had the same buy and sell signals, exactly the same. But the guy that lost money on one trade, he had like 10 contracts. It was a big losing trade. On the next winning trade, he had 1 contract. So he didn't make as much money as what he had lost. Then there was a real good signal. He decided, this doesn't work, so he didn't have any contracts on that one. Then he saw that was a really good trade, so he says, I'm getting back on that hotline. And of course, he had a losing trade. So he was not consistent in his money management. And that's why money management is so important. It's the consistency in recognizing some people can do this and some people can't do that. But let me tell you this, when you find out you can do it, if that's you, and it's happened to so many people. I've had so many people who have quit their jobs, have quit being airline pilots, quit farming, quit being bankers, quit being mutual fund managers, and now trade full time from what they've learned from me. Your whole life totally changes. You have so much freedom in your life, but it takes a while to learn to trade. And on the next videotape, I'm going to show you more about the specifics of trading. Hopefully on this one, what you learned is the general aspects of the market, what's important about the delivery contract specifications, all the basics of the market. And you at home will want to rewind this now and come back to the next videotape where we're going to start to get into what makes markets go up, what makes markets go down from a fundamental and commercial aspect basis. So see you on another videotape.